Listen, this is about protecting capital, not protecting egos. I'm going to give you a rule that prevents the most expensive mistake investors make in every cycle, confusing activity with progress. I've watched this error compound into real losses, quietly, right up until the market forces the lesson. What I'm saying today is not popular. It doesn't need to be. It needs to be correct. Most people invest blindly because they think being invested is the same as being positioned. Those are not the same thing. One is exposure, the other is intent. And if you're holding assets without a rule that controls your risk, your timing, and your behavior, then you're not investing. You're participating. There's a difference. The rule is simple. Only buy an asset if you can clearly answer two questions, without emotion, without hope, and without outsourcing the thinking. What is the cash flow, and what is the price of that cash flow? If you can't answer those two questions in plain English, you do not own an investment. You own a story. And stories are what get sold to you at the top. Most investors don't like that statement because it removes their favorite excuse. I didn't know. You did know. You just didn't want to measure. Here is the philosophical mistake. People believe the market rewards conviction. It doesn't. The market rewards correct positioning and patience, and it punishes fragile logic. Conviction is cheap. Anyone can feel strongly. The market doesn't pay you for feelings. It pays you for enduring volatility while holding assets that deserve to survive it. That's why the rule matters. It forces you to build a portfolio like a professional, not like a spectator. The average investor thinks in terms of predictions. They want to know what the Fed will do, where inflation will go, whether the market will rally next month. I don't build portfolios around predictions. I build portfolios around inevitabilities. Refinancing cycles, profit cycles, liquidity cycles, and human behavior when money gets expensive, because those are the forces that actually move capital. When you accept that, you stop looking for the next winner, and you start building an allocation that can win regardless of which headline dominates. I've seen multiple versions of the same cycle, a period where money is cheap and people call it a new era. Then the cost of capital rises and suddenly fundamentals matter again. Then weak balance sheets crack. Then investors rediscover that cash flow is real and narratives are not. I've seen this in tech booms, housing booms, credit booms, and in the slow motion cycles people ignore because the pain isn't immediate. The market doesn't usually punish you with drama at first. It punishes you with underperformance. Then it punishes you with forced decisions at the worst time. That's what blind investing creates, forced decisions. And once you're forced, you're no longer managing capital. You're managing damage. So here's the framework I use. Every cycle, every time, because it works precisely when people get emotional. First principle, cash flow is the only thing that makes an asset self-justifying. Cash flow can be dividends, it can be coupon payments, it can be rent, royalties, or operating profit. It can even be the economic utility of an asset that reduces a cost or increases pricing power. But it must be real, measurable, repeatable. If an asset produces nothing, then the only way you win is if someone else pays you more later. That can work, sometimes, for a period. But understand what it is. You're depending on liquidity and enthusiasm. Liquidity and enthusiasm are not stable inputs. Second principle, the price you pay determines the risk you take. Two people can buy the same asset and have completely different outcomes because they paid different prices. Price is not a detail. Price is the deal. Price is where risk lives. If you pay a premium for an asset, you have made an assumption about the future, and assumptions are fragile in a tightening environment. Third principle, duration is the silent killer most investors don't model. Duration is a concept from bonds, but it applies to everything. If the value of your asset is mostly in the distant future, you are long duration. If the value of your asset shows up as cash flow today, you are short duration. When money is cheap, long duration gets rewarded because discount rates are low and people can afford optimism. When money is expensive, the market demands near-term cash flow because it doesn't trust distant promises. This is why certain growth stocks look invincible in one phase and then look obvious in hindsight in the next. It wasn't the story that changed, it was the discount rate and the cost of capital. Fourth principle, you do not get to ignore balance sheets. A balance sheet is a survival document. In higher rate environments, the balance sheet decides who lives long enough to benefit from the turn. If you're holding companies with heavy refinancing needs, weak interest coverage, and thin margins, you're holding assets whose future depends on credit conditions staying friendly. Credit conditions do not stay friendly. They oscillate. Your job is to own things that can survive the oscillation. Now I'm going to give you the rule in its operational form. It's not complicated, and that's why it works. I call it the two-price rule. Every asset has two prices. There is the market price, what you pay today, and there is the economic price, what you are actually paying for cash flow, resilience, and optionality. Blind investors look at the first price. Professionals obsess over the second. Here's how it works. Before I buy anything, I want to know the yield of the asset in a way that reflects reality, not marketing. If it's a stock, I care about free cash flow yield and earnings quality, not just EPS. If it's a bond, I care about yield to maturity, covenants, and the ability to refinance. If it's real estate, I care about cap rate, debt service coverage, occupancy stability, and maintenance reality, not a brochure rent projection. If it's a private deal, I care about how cash gets returned and what happens in a down year. If it's a commodity position, I want to know why I own it and what regime it protects me from, because commodities are not investments in the same way a business is. Then I compare that economic yield to the risk-free alternative. This is where most people get uncomfortable because it removes fantasies. If T-bills pay a meaningful yield, then any asset I buy must beat that yield after adjusting for risk. Not beat it with potential, beat it with economics. If it can't, then I'm not being paid to take the risk. And if I'm not being paid, I don't take it. This is the line between investing and blind participation. Now let's get specific, because without specificity, this becomes philosophy, and philosophy doesn't protect money. Right now, the investor's world is defined by one central fact. The cost of capital is no longer negligible. That has consequences. It changes how companies behave. It changes how consumers behave. It changes how governments behave. And it changes what the market rewards. When money costs something, leverage stops being a cheat code. A lot of business models were built on the assumption that refinancing would always be cheap. That assumption is not permanent. So the first thing I do is separate my investable universe into three categories. Category 1, assets that can self-fund. These are businesses with consistent free cash flow, manageable debt, and the ability to buy back shares, pay dividends, or reinvest at decent returns without begging the credit market. This is where safety lives, not in low volatility, in self-funding capability. Category 2, assets that are viable but cyclical. They can perform extremely well, but they need competent management and a rational entry price. They don't deserve a permanent premium, but they can be excellent holdings if you pay the right price. This is where most disciplined investors make money, buying cyclicals when pessimism is priced in and selling when optimism gets reckless. Category 3, assets that require the kindness of strangers. They require continuous external financing, perpetual optimism, or very benign macro conditions. This is where blind investors lose money because the music can stop and the fundamentals don't catch you. If you're holding Category 3 assets today and calling them long-term investments, you need to understand what you're actually doing. You're making a rate bet, you're making a liquidity bet, you're making a sentiment bet, and you're pretending it's something else. I don't say that to criticize. I say it because precision matters. Now, let's apply the two-price rule to the real world. First, public equities. Most people treat stocks as lottery tickets. They look at charts, they look at excitement, they look at what's been going up. Professionals look at cash generation, pricing power, and how the business behaves when demand softens. If you own equities, you should know the business model in one sentence. How does it make money? Why will it keep making money? And what can realistically disrupt it? Then you need to know what you paid for that reality. If your stock trades at a valuation that implies perfection, you're not investing in a business. You're investing in a future that has to go right. And if your portfolio needs everything to go right, you have built a fragile portfolio. A fragile portfolio is fine until it isn't. Second, fixed income. Most retail investors ignore bonds until stocks get scary. That's backwards. Fixed income is not about fear. It's about controlling your outcome. The bond market is where the cost of capital is set. It is where stress shows up first. It is where refinancing risk becomes visible. And in certain regimes, it offers a very simple advantage. You can earn a known return without relying on multiple expansion. When I can get attractive risk-free yield, I become more demanding elsewhere. That's discipline. Third, real estate. Real estate exposes blind investing faster than almost anything because debt is explicit. When rates rise, your cash flow doesn't just get pressured, it can get erased. If you own property with floating rate debt or near-term maturities, the question is not whether the property is good. The question is whether the financing terms will crush your equity before the market recovers. Real estate is a spread trade between your cap rate and your cost of debt. When that spread compresses, you feel it. And if you can't refinance, you find out what illiquid actually means. If you're holding real estate today, the rule is simple. Your debt maturity schedule matters more than your opinion about the neighborhood. Fourth, alternative assets and private markets. Private markets are where marketing thrives. Returns are shown without context. Valuations are smoothed. Liquidity is deferred. And people confuse not seeing a price with not having risk. If you're allocating to private deals, you need to know two things with cold precision. How do I get paid and how do I get out? If the answer is vague, it's not sophisticated. It's dangerous. Now, I'm going to talk about the part investors hate because it forces accountability. Blind investing is usually a symptom of a deeper problem. Investors don't have a decision rule. They have a mood. They allocate based on confidence, headlines, and recent performance. When markets are rising, they think they're skilled. When markets fall, they think it's unfair. It's neither. It's just a lack of a rule. So here is the rule you adopt if you want to grow wealth faster without increasing ruin risk. I only add risk when I'm being paid for it, and I measure paid as follows. 1. The asset produces cash flow now or has a clear path to producing it in a time frame I can underwrite. 2. The valuation is reasonable relative to that cash flow, meaning I have a margin of safety, not a margin of hope. 3. The balance sheet can survive the environment if the environment gets worse before it gets better. 4. I have liquidity and sizing discipline, meaning no single position can force a decision. That last point is where intelligent people still fail. They buy good assets in bad sizes. They turn a sensible thesis into a portfolio risk event. If you are concentrated, you have to be right. If you are properly sized, you can be early. And being early is often the price of being correct. Now I'm going to break down how the two-price rule plays out when the market turns, because that's what everyone cares about. A turn is not a headline moment. A turn is a capital flow shift. It usually happens in stages. Stage 1. Denial ends. The market stops paying high prices for weak quality. Speculation starts to underperform. That doesn't mean a crash. It means leadership changes. Stage 2. Stress concentrates. The weakest balance sheets begin to show strain. Credit spreads move. Refinancing becomes more expensive. The market becomes discriminating. Stage 3. Policy and liquidity adjust. Either inflation cools enough to allow easing, or something breaks enough to force easing. Either way, the marginal cost of money changes direction. Stage 4. Re-rating begins. Assets that were priced for disaster re-rate upward. Assets that were priced for perfection struggle. This is the part where late investors feel regret, because the market moves before the headlines improve. That is always how it works. Now, if you have followed the rule, you benefit from the turn in a controlled way. You have cash flow. You have liquidity. You have assets that are self-funding. You have optionality. You can add risk as the market offers it, instead of adding risk because your emotions demand it. If you haven't followed the rule, the turn becomes a problem, because you're trying to recover. And recovery is a terrible mindset for allocating capital. Recovery makes you chase. Recovery makes you rationalize. Recovery makes you buy what already moved. Now let's neutralize the objections calmly, because they will come up. Objection 1. This is too conservative. The fastest way to build wealth is taking risk. No. The fastest way to build wealth is compounding without interruption. The biggest threat to compounding is not low returns. It's large drawdowns and forced selling. Risk is not the enemy. Uncontrolled risk is. If you want to grow wealth faster, you need fewer catastrophic mistakes, not more excitement. Objection 2. Great companies are always worth paying up for. Sometimes, but valuation still matters. A great company bought at a reckless price can be a mediocre investment for a decade. That is not theory. It is history. If you pay a premium, you are borrowing returns from the future. Borrowed returns come with conditions. Objection 3. Markets are random. Rules don't work. Markets are not random. Short-term price moves are noisy, but incentives are not random. Liquidity cycles are not random. Balance sheets are not random. Human behavior under stress is not random. Rules don't eliminate uncertainty. They eliminate self-destruction. That is the entire point. Now I'll give you the forward-looking warning without drama. If you ignore this rule, you will eventually own assets you do not understand at prices you cannot justify. You will call it long-term because you can't admit it was a bad entry. You will sit through volatility because you have no plan. And when the market offers you the real opportunity, when quality is cheap and liquidity is rewarded, you won't have the emotional or financial bandwidth to act, because your capital will already be committed to positions that need time and hope to recover. That's not a tragedy, it's a choice, and it's avoidable. If you adopt the two-price rule, the next cycle becomes an advantage. You will be patient when others are reactive. You will be liquid when others are trapped. You will add risk when others are forced to reduce it. That is how wealth compounds faster without increasing the probability of ruin. Not by being brave, by being structured. Now, if you want continued clarity like this, measured, unemotional, and rooted in how capital actually behaves, subscribe. Not for entertainment, for repeatable thinking. And watch the next analysis, because I'm going to be specific about the positions that look normal right now, but become extremely dangerous when the market turns and credit tightens. If you have real money at stake, you don't need more opinions. You need better rules.